Most people think fertilizer businesses fail in West Africa because farmers are poor, infrastructure is weak, and government interferes too much. But data shows that demand is not the problem. In fact, fertilizer use in West Africa is far below the global average usage, which means the market should be attractive. So the question again here is, why do fertilizer businesses still fail? Let's look at the evidence. West Africa has one of the lowest fertilizer application rates in the world. According to the Food and Agriculture Organization, FAO, Sub-Saharan Africa averages 17 kilograms of nutrients per hectare. The global average is over 135 kilograms of nutrients per hectare. So this means soil nutrients are depleted, yield gaps are massive, and farmers want higher productivity. Clearly, demand exists, yet companies still fail. So demand is not the bottleneck here. Multiple studies from the International Fertilizer Development Center shows that fertilizer market in West Africa is highly fragmented. Last mile distribution is dominated by informal agro-dealer networks. And again, control also sits outside the formal contracts. Many manufacturers assume once the fertilizer hits the country, distribution will sort itself. In reality, pricing control is lost. Cash collection weakens. Margins leak before reaching the farmer. If you don't control the last mile, you do not control your business. The World Bank consistently highlights that credit risk is the major failure point in agri-input markets. Key findings across West Africa indicates that fertilizer sales are often financed by suppliers. Payment cycles regularly exceed 90 to 180 days. Legal enforcement is slow or impractical. This turns fertilizer businesses into an unregulated lenders. Sales may grow, revenue may look strong, but cash doesn't return. Most fertilizer businesses do not fail due to lack of sales. They fail due to lack of uncontrolled receivables. Government fertilizer subsidy programs are widespread across West Africa. But according to Joint World Bank and International Fertilizer Development Center evaluations, subsidy payments are frequently delayed, price controls compresses the margin, and product diversion is common. Subsidies create the illusion of volumes, but volume without predictable cash flow, pricing freedom, or enforcement mechanisms can easily destroy healthy businesses. Subsidies are not a strategy, they are a high-risk exposure. Here's the problem many new entrants underestimate. Fertilizer raw materials are priced in USD. West African currencies are historically volatile, and sales are made in local currencies. Between 2020 to 2024, most West African currencies experience double-digit depreciation. This means you can sell more fertilizer, grow your market share, and still lose money in dollar terms. Growth without FX management is not growth, it's simply erosion. Why do fertilizer businesses really fail in West Africa? It's definitely not because of farmers, not because of demand, but because of poor distribution control, excessive credit exposure, over-reliance on subsidies, forex mismatch, weak operational systems. This is a risk management business, not just agriculture. Case studies highlighted by IFDC and the World Bank shows that agri-input businesses who survive this tend to shorten cash cycles, limit credit strictly, build parallel private distribution channels, reduce FX exposure through local lending, design products based on soil data, not generic formulas. West Africa is not a fertilizer problem. It is a control problem disguised as agriculture. In the next video, I will explain who really controls fertilizer distribution in West Africa. This place is not for everyone, but those who understand it, the opportunity is real.